Hey guys, welcome back to our series on commodity trading. As we mentioned in the oil video, each week we're going to be discussing two separate commodities. We're going to attempt to learn more about them and find out if they're potentially right for you. Today we're going to be discussing coffee futures, which are considered a soft commodity. A soft commodity refers to natural cultivated products that are grown rather than mined or drilled. These commodities are essential to global trade and are often traded in the form of a futures contract. Unlike hard commodities like metals and energy, softs are agricultural products that require nurturing and harvesting. We'll first start off with a brief description and then go on to a small brief technical picture of the commodity. At the end of this video, you will have some basic knowledge where you'll be able to know whether or not coffee futures are right for you. Above all else, please do your own research before attempting to trade any market. So before we get into the descriptions and moving forward, let's just say it because I know you're all thinking it, coffee futures. How cool is that? I mean, let's be honest. If you go over to someone and you're talking about any of your trading buddies and you're talking and they say, well, what do you do? And the guy says, oh, I'm an energy trader. Or one guy says, oh, I'm an indice trader. Imagine the showstopper when you say, oh, I'm a coffee trader. I mean, that's pretty cool. Let's be honest. It is cool, right? Okay. Now we got the coolness factor out of the way. Let's move forward. So first, a brief overview, and then we'll get into some other fundamental type of descriptions, and then we'll get into the technical picture. First of all, there are three types of coffee that are traded. We're going to focus on the main two types, but we'd be remiss if we didn't mention all three of them. Okay, there's Arabica, Robusta, and then there's green coffee. Okay, Arabica is known for its sweeter taste and higher quality. It's predominantly grown in Brazil and requires fertile soil, shade, and sunlight. It's more vulnerable to pests and cold, wet weather, and is typically sold in specialized coffee shops and supermarkets. Arabica trades on ICE US. Each contract controls 37,500 pounds of coffee. It's $18.75 a tick, and it trades in 5-cent increments, which means it goes from, let's say, 139.05 to 139.10, 139 spot 15, etc., 139 spot 20, etc., etc. It trades in 5-cent increments. So every tick is equal to $18.75. The next one is Robusta. Robusta beans are easier to farm and grow at altitudes of 200 to 800 meters. They're less expensive to produce and yield more than Arabica. Robusta is valued for its cost effectiveness and resilience, making it a staple in instant coffee and espresso blends. Robusta trades on ICE EU. Each contract controls 10 tons. It moves in 1-cent increments. Each tick is equal to $10. That's the way they trade. There's another contract which is exclusive to the Tokyo Grain Exchange, and that tracks the price of green beans which are imported into Japan. That's all I'm going to say on that. We're going to primarily focus now on just coffee futures from either the Arabica or Robusta point of view, on either ICE US for Arabica or ICE EU for Robusta. Okay? So, as we go. So, the purpose, the benefit, the risk, and the challenges in trading the coffee market. The primary purpose of them is to provide a platform for participants within the coffee industry to manage risk. Producers, buyers, processors, exporters, and roasters will often use futures contracts to hedge against adverse price movements. By locking in future prices through a futures contract, market participants can ensure a certain level of price stability and protect themselves from potential losses caused by unexpected price fluctuations. Coffee futures offer several benefits to market participants. For coffee producers, a futures contract provides a way to secure a predictable income by locking in price for their crops. This stability allows producers to budget effectively and plan future production strategies. For buyers, coffee futures provide an opportunity to manage price risks and ensure a steady supply of coffee beans. Additionally, coffee future markets offer liquidity, transparency, and a fair pricing mechanism, attracting a wider range of market participants and fostering a competitive marketplace. While coffee futures can be a valuable tool for managing price risks, they also come with a certain inherent risk and challenge. One of the primary risks is the possibility of unfavorable price movements. If the market price of coffee moves in the opposite direction from what was anticipated, hedgers may still incur losses despite their hedging efforts. Another challenge is market volatility, which can be influenced by various factors such as political instability, weather conditions, and changes in consumer preferences. Now let's talk about factors that affect price. The first one, supply and demand. We all know what supply and demand is, right? So we're gonna move on. Weather. Weather is a big one. Weather. Coffee is a tropical crop, primarily grown in countries such as Brazil, Vietnam, Colombia, and Ethiopia. Therefore, weather conditions in these regions play a crucial role in determining coffee future prices. Adverse weather events like droughts, frosts, heavy rains, or even hurricanes can lead to significant crop damage, reduce yields, and disrupt supply, causing price spikes. Political and economic factors. Yes, political and economic factors do play a role in coffee. Political stability and economic conditions in coffee-producing countries can have significant impact on coffee future prices. Government policies, trade regulations, taxation, and currency fluctuations can all affect the cost of production and international competitiveness. Additionally, economic growth rates and income levels in major coffee-consuming countries can influence demand and consequently prices. Currency exchange rates. Coffee is an international traded commodity, and its prices are denominated in US dollars. Therefore, fluctuations in currency exchange rates, especially the value of the US dollar, can impact coffee prices. A weaker US dollar typically leads to higher coffee prices as it takes more dollars to purchase the same quantity of coffee. Another factor that plays in is the Brazilian real, because most coffee comes from Brazil, so the Brazilian real, which is the currency of Brazil, also plays a part in coffee prices. Global consumption trends. Consumer preferences and trends can also influence coffee future prices. Changes in taste, health considerations, and marketing efforts by coffee companies can impact demand levels. For example, I'm talking to you, Starbucks, a shift towards specialty coffee or the introduction of new coffee-based beverages can drive up prices for certain types of coffee beans. So if Starbucks decides to introduce some new wacko type of drink, it could have an effect on coffee prices. So you're going to say, why? Well, the reason is that Starbucks is so large that they actually can influence the price of coffee. Hedging with futures contracts, or coffee futures in this case. What is hedging? Now, this is going to apply to every single commodity out there. It's not specific to coffee. We're going to have it here for coffee, but it is not specific only to coffee. Okay? Hedging is a risk management strategy widely used in the coffee industry, as well as all commodity industries. Coffee producers, exporters, and other market participants hedge against price volatility to protect their financial interests. Hedging is the process of offsetting or reducing the risk of adverse price movements in the physical market by taking an opposite position in the futures market. By doing so, market participants can lock in a specific price for their coffee, ensuring a predictable income or cost of procurement. Coffee producers often face uncertainties related to fluctuating market prices, crop yields, and production costs. By hedging their coffee in the futures markets, producers can protect themselves from potential losses caused by price declines. Hedging also provides financial stability and enables producers to plan their operations more effectively. To hedge against price volatility, coffee producers sell coffee future contracts to establish a short position in the market. This means that if the price of coffee falls, the gains from the short that they have on in the futures can offset the loss in the physical market. If the price rises, the producer can still sell their coffee at a higher market price, even though they're going to incur a loss in their futures position. So even though they may lose money on their hedge, they'll still make up the difference in the physical market for physical beans. Determining the appropriate hedge ratio is important for effective hedging. This hedge ratio represents the quantity of futures contracts needed to offset the risks associated with a specific physical position. It takes into account factors such as the correlation between the future and physical markets, market conditions, and the desired level of risk mitigation. While hedging can reduce the risk of adverse price movements, it's important to note that it is not entirely designed to eliminate risk. Hedging strategies may involve costs such as brokerage fees, margin requirements, and potential market inefficiencies. The effectiveness of a hedging strategy depends on market conditions, the accuracy of price forecasts, and the ability to execute hedges at favorable prices. What this is saying is that even if you do everything right, you can still be wrong on your hedge. Speculators on the coffee futures, or speculators in general. Speculation in coffee futures refers to trading based on expectations of future price movements, without the intent to take physical delivery of the coffee. That means traders, not people who are working for producers or who are working for exporters or people who are in the coffee industries. This is pure price speculators. Speculation involves taking positions in coffee futures with the intention of profiting from price fluctuations. Speculators aim to forecast price movements and take advantage of these forecasts to achieve financial gains. Speculators play a vital role in providing liquidity and fostering efficient price discovery in coffee future markets. By taking opposite positions to hedgers, speculators create market depth and improve the overall functioning of the market. Their participation adds liquidity and allows hedgers to find counterparties willing to take the opposite side of their trades. In honor of our discussion today, I even made my background on the computer coffee, so you can see that. Yeah, it's a cool topic. Let's be honest. I know you listened to this whole thing, and now you have a little bit more of a fundamental idea of what's going on, at least from a definitional standpoint. But let's be honest. If you're here to learn about coffee futures and you want to trade coffee, there's a coolness factor to it too. It's okay. You can admit it. I trade them, and I admit it too. It's the coolest thing. When people ask you, "Oh, I traded coffee today," it's like it's a page turner. Okay, so let's discuss how the futures move, and we'll go from there. So first, let's just take a quick look, because I know a lot of you probably have not seen a coffee contract before. So to you, this is like unbelievable. So let's just discuss it. Okay, as you can see, it's had a ginormous move. It's really had a big move off of, going into the start of basically from 23. This is a monthly chart. I mean, it's been basically from October of 23. It's been to a large extent just like straight up. You could even say on the monthly, it's almost like parabolic. I mean, it's just been ginormous. It's been a lot of fun to trade. So that's like our monthly picture. So on the monthly, it's very bullish. I mean, let's not kid ourselves. Okay. Let's go to a weekly, just so we could see what's going on over here. Let's get a little bit more of a a little bit more of a technical picture. Again, you can see almost from basically October time, it's pretty much just been to a large extent straight up. I mean, if you were a stock trader, this is what you would want to be in this. I mean, there's no reason why you wouldn't be. It happens to be it's coffee, but I mean, look at this. It's amazing. And to be honest with you, when companies see this, like a Starbucks, for example, I'm just using them because they're big. They're raising prices is definitely in their wheelhouse. They're looking at it because, like, what are they supposed to do? There's only so much they can sustain, even on hedges. So they will be looking to raise prices. Almost, we talked about in the weekend video that I did on Commodities about cocoa. When we get to cocoa, it'll be a little bit more apparent. We'll discuss cocoa also, but that'll be in a future video. But you can see here, you could see why why Starbucks would be raising their prices. Let's look at a daily now, and then we'll go into intraday to kind of understand how this works. Okay. So this is a daily chart of coffee. Okay, so the first question you're going to ask me is coffee trade like a lot of commodities that you're used to? Let's say, for example, like oil, gold. Even though you shouldn't be trading them all night long, they do trade 23 hours a day. Coffee does not. Coffee's hours are from 8 o'clock in the morning until 12:25 or 12:30. Well, 12 o'clock. They'll open up around 4 o'clock in the morning Eastern. There's nobody really there. That's when London opens. There's nobody really there. They're not active, like, at all. And they finally start to wake up around 8 o'clock Eastern time in the morning is when they start to wake up. But you only have a limited amount of time, because by 12:25 the market's closed, and then by 1 you have like a little bit, like a half hour or so of like a little bit of Globex, and then that's it. And then they close the door, and I'll see you tomorrow. But again, you can see that it's very tradable. It's a very tradable product. I think the problem that makes coffee futures scary, number one, is that the lack of ICE data for a lot of people. They don't know what they don't know, so they just get scared by what they don't know. The tick value. And the reality is that a lot of these commodities on ICE don't have the volume and the liquidity that you're accustomed to. So, for example, oil or gold or even natural gas, they're doing on average, let's just assume on average, each one does north of 100,000 contracts, even say, let's say even 200,000 contracts, let's just say. On ice, they're not doing that. I would say coffee's average, a heavy day is about 30, 40,000 contracts, maybe 50, but about 40,000. The heaviest thing liquidity or volume wise on ice is sugar, and that trades about 65 to 70,000 contracts. So an average day here is about 30,000 contracts in coffee. One of the things that coffee does, which is really, really cool, is it's very respectful. Like we said in the oil, like I said in the crude oil video, someone needs to be there. So if no one's there, these things are not going to move. Someone has to be there. So a lot of times, if the market's dead, the market's dead. So you can't force things here. You have to be really, really careful and understand what you're trading. The other thing is that coffee moves very, very cleanly, like really clean. You can see here, it's got some nice moves. But again, it's understanding the math. It doesn't always have clean moves. A lot of times it's just kind of dead in the water and doesn't really go anywhere. But again, it's $18.75 a tick and it trades in 5-cent increments. So let's just do some quick math just so we should understand what are we talking about here. So if it's moving, if 50 cents is $1, right? Because it moves in 5-cent increments. So if you do, let's just do 100 divided by 5, means there's 20 ticks for $1, right? Like trading treasury. The one thing that you need to understand with them more than anything else, let me just get up the daily chart a second because this is going to be quite important, is coffee is very volatile. It is a very, very volatile commodity. I'm not going to sit here and lie to you and tell you that it's for the faint of heart. It is not for the faint of heart. It is very volatile. If you catch a nice move, great. If you don't know where you're getting out, if you're wrong, you could get hurt very easily and very quickly in it. Again, there's a lot of slippage because the liquidity is not there. So before you would get into this, you would really need to understand the way it moves, how it moves. I will give one caveat. Most commodities, with the exception of energy and gold, they all pretty much move the same. What I mean by that is they're not really, when I say energy, I'm really specific to crude, and I would say even depending on the seasonality, whether it be gasoline or heating oil. Most commodities, whether it be agriculture, everything in the agriculture space, wheat, beans, corn, coffee, sugar, cotton, etc., they all move the same. Meaning, even if they have the liquidity or not, they're all moving in the same way. So you have to understand, like I said in the first video on oil, please reference, and I'm going to reference a link there. You have to have patience. The commodities do not just rip all over the place like a stock. So they're very, very boring. But I hope you found this video to be informative and you enjoy it. If you did, please like and subscribe, and I'll see you on the next one. Take care.